The IRR and the equity multiple both serve really important functions within a real estate investment analysis, but these also serve very different purposes when it comes to the underwriting process. And even though these tend to be added to financial models and investment materials alongside each other, the importance of each of these can vary a lot on a deal-by-deal basis, depending on the specific strategy you're ultimately planning to pursue. So whether you're an investor trying to evaluate your own opportunities or you're working as an analyst within a bigger firm, this video will walk you through when you might want to focus on the IRR over the equity multiple and vice versa, and why that might be the case in each of these scenarios. So I want to start this video off by breaking down what both the IRR and the equity multiple measure, since these represent two very different things. The IRR stands for the internal rate of return, and this represents the time-weighted annualized return on capital invested in a deal, and this is also expressed as a percentage value. Alternatively, the equity multiple measures how many times over an investor earns their capital contribution back throughout the entire investment period, and this is expressed as a numerical value, usually out to 1 or 2 decimal places. And in real estate, both of these metrics serve a purpose, but the practical application of each of these can be very different, and the first thing you want to factor in when deciding which of these to weigh more heavily within your analysis is how long you're planning to own the property you're pursuing. For longer hold periods of about 10 years or more, the IRR tends to be a much more helpful metric to focus on for a few different reasons. First, because the equity multiple calculates the number of times over the investor earns their capital contribution back throughout the entire hold period, this number will by default become bigger and bigger as the hold period also increases, meaning that you can automatically make a deal look more attractive on paper just by pushing back the projected sale date. But with the IRR, this figure is often much more consistent across a 10, 15, or 20-year hold, so while the equity multiple might spit out huge numbers in these scenarios that are pretty difficult to compare to other investment vehicles like stocks or bonds, the IRR can give you a clear annualized percentage return regardless of how long you plan to hold an asset. Now, on the other side of the spectrum, for very short hold periods of just 2 to 3 years in length, the equity multiple starts to become significantly more important for very similar reasons. Since the IRR is a time value of money metric, this means that cash flow received earlier on in the hold period is weighted more heavily than cash flow received later on in the hold period, and similar to how the equity multiple continues to increase when the hold period increases, for most value add or opportunistic commercial real estate deals that see a quick spike in rents after acquisition, the IRR will also tend to increase when the hold period is shortened. And even though this higher IRR value is real on the surface, a 25 or 30% annualized return that's only going to be generated for 24 or 36 months might not be worthwhile in relation to the whole dollar profit you can expect to earn, and also the risk associated with an investment that depends almost entirely on hitting a speculative sale price in order to generate returns. And where the equity multiple comes into play here is that this can give you a much more complete picture of the actual cash you can expect to be distributed throughout the life of a deal. So while a 30% IRR might look good on paper, a 1.7x equity multiple can help you actually quantify what that return means on a whole dollar basis. Now, the next situation I want to bring up here doesn't necessarily have anything to do with a deal itself, but instead how you're investing in a deal, and whether you want to focus most on the IRR or the equity multiple will also come down to whether you're investing in real estate as an active general partner or a passive limited partner. As a general partner or GP, whether you're running a deal yourself on behalf of a group of investors or you're working as part of a larger company, a huge portion of your upside is very likely going to be tied to promoted interest or an outsized portion of the profits you'd earn over a certain return hurdle. And in the vast majority of cases, especially when raising capital from institutional capital partners, this promoted interest amount is going to be dependent on exceeding a target IRR value. And this means that when acting as a GP, you'll often be focused most on optimizing that internal rate of return ahead of optimizing the equity multiple. And since IRRs are often highest with shorter hold periods, and shorter hold periods also tend to maximize things like acquisition fees, construction management fees, and disposition fees, many general partners are focused on quickly returning capital to investors and starting the process over as fast as they can. Now, if you're investing on the other side of the table as a passive limited partner, with all of this in mind, this also means that you're going to want to keep a very close eye on the equity multiple on these deals, especially if the GP's incentives are based exclusively on a target IRR. This is also why some limited partners will not only require an IRR-based return hurdle within their waterfall structures, but also an equity multiple-based hurdle alongside this to make sure that the GP can't just quickly flip assets to juice returns, and they need to generate significant distributions over a sustained period of time. Now, the last scenario I want to mention here where the importance of the IRR and the equity multiple is going to differ is when there's a significant cash out refinance planned before the property is projected to be sold. Because the IRR is a time value of money metric, a big cash inflow early on in the hold period is going to increase this, but unlike a quick sale, you'll still be able to hold on to that asset over the long term and avoid the drag of transaction costs associated with things like brokerage commissions, legal fees, and transfer taxes on the deal. And this cash generated through that refinance can then be used to turn around and make another similar investment while continuing to hold on to the original property, which allows investors to move a lot more quickly than they otherwise would have been able to without that refinance occurring. And even though this is usually going to decrease the projected equity multiple on a deal very slightly as a result of increased interest costs on a bigger loan amount, in most cases, the increase in IRR is going to be a lot more impactful for investors and is going to more than offset the slight drop in multiple. For example, if we take a look at a typical value add deal with strong assumed rent growth in the first few years of the hold period, over a 10-year time frame, this deal would produce an 18.2% IRR and a 4.3x equity multiple. However, if we were to assume to refinance that property at the end of year 3 instead, at that same going-in LTV ratio and that same interest rate, keeping that same 10-year hold horizon, our equity multiple drops very slightly to 4.0x, but our IRR now jumps by 400 basis points to 22.2%. And even though a 4% increase in returns might not seem like a lot, the future value of our original $4.5 million investment would be substantially different over a 10-year period at these two rates of return, with an 18.2% IRR growing this amount to $24.3 million at the end of 10 years, but a 22.2% IRR growing this amount to over $33.8 million at the end of a 10-year period. This is why in these cases, the IRR can be even more important to focus on than the equity multiple, since you're able to get the benefits of both a return of capital sooner while still allowing your money to compound in the original deal you invested in over a sustained period of time. So the IRR and the equity multiple are both extremely important metrics, but I hope this is helpful as you're analyzing different deal scenarios and trying to figure out which one matters most. And if you want to learn more about different real estate return metrics, how these are incorporated into a real estate pro forma, and how to analyze deals across a variety of different product types, make sure to check out our all-in-one membership training platform, Breaking into CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Break into CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more deep dive content on the channel on different return metrics, make sure to hit the like button and let me know in the comments which metrics you focus on most when you're analyzing real estate deals. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.